Tom Boley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody, and welcome to this Wednesday, February 28th, 2024 edition of Trading Places Live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes or so as we take a look at what happened yesterday in the market and maybe take a look ahead, what we might expect in the day ahead. We did have cruise lines taking off yesterday. We had a report out of Norwegian cruise lines, and the initial number I thought they had missed, and I didn't go back and confirm one way or the other, but was surprised to see Norwegian lead the S&P 500 to the upside. Carnival also having a big day, so the entire group leading the recreational services area of consumer discretionary to the upside. We're going to take a look at all that in just a minute. Just got GDP out for the fourth quarter. This was the second estimate, and it was expected to come in 3.3%, came in just shy, 3.2%. That combined with the PCE annual rate jumping a little bit higher than expected, has futures a bit lower. Let's see. Currently, we've got the all the major indices are somewhere around 0.2% to about 0.4% lower. So not a big deal, but at least a little bit to the downside as we get the day started. Of course, as we've been seeing of late, seems like we've had morning weakness and then we get some buying later in the day. It's been somewhat of a bifurcated market here recently. Some indices a little higher, some a little lower. The key ones, I would say technically, probably the biggest one is the Russell 2000, still trying to get through the 205 level. Yesterday closing at 204, very close to breaking out of its current cup with handle pattern. The others just kind of moseying along. They'd recently broken out to all-time highs, been consolidating, digesting those gains of late. So not really anything horrible going on in the market. We do still have little slight negative divergences on daily charts that we might see play out, although I argued against that, I think, during yesterday's show. So really just a market that's consolidating more than anything else. We're trying to digest all those gains from October through earlier this month. And now we're into a period where his history tells us that the market generally struggles, or at least doesn't do a whole lot of anything, more sideways action than anything. So how are we going to come out of all this? Your guess is probably about as good as mine. I can tell you that my signals remain very bullish. Anything that is bearish that I'm looking at is very short-term in nature. And so that's kind of the way I'm playing the market right now. Personally, I'm staying long. I've said all along, you don't bet against a secular bull market advance. I don't care what you're seeing out there. Everything I look at in terms of my signals are secondary to price volume. So price volume continues moving up, and we're trading above the 20-day, and the 20 days above the 50-day, and we're sitting basically in all-time high territory. It normally doesn't pay to try to bet against the market. And most folks that are trying to bet against the market now are using fundamental excuses. They ran out of technical excuses long ago. And so now it's, in order to feed that confirmation bias, that bearish confirmation bias, you got to look to fundamental news. And you can always find plenty of that. Market goes, you need to follow the technicals as far as which way the market's going. The secondary indicators can provide, especially if you have a lot of them that go together, can provide us clues about short-term market direction. But overall, long-term, I mean, you've got to start with price volume, and still looking pretty strong, and especially when you see patterns like that continuation cup with handle on the Russell 2000. It's hard for me to argue with that. As long as those patterns are in play or they execute, I think we've got to continue to stick with what's working, which is the current bull market. All right, let's go ahead and get started here. I also want to mention, if you like the video, make sure you hit that like button, and also subscribe to the channel. These are two ways that'll help us, even if you're not a member of EarningsBeats. Of course, we always encourage you to take out a 30-day trial. Just go over to EarningsBeats.com. You'll see the button top of the screen. If you don't see it, you'll see it in just a few minutes. when I get to the chart of the day. But let's start off what happened on Tuesday. Well, Dow Jones Industrial Average finished down 97 points. That was about 0.25%. S&P 500 rose a little more than 8 points, which was close to 0.2%. The NASDAQ 100 rose just over 0.2%, gaining 37 points. Mid caps up a little more than 0.4%, gaining 12 points. And the small cap IWM gaining 1.4% yesterday. Again, up near that or closing at that 204 level, rising $2.85 yesterday. So a big day on the IWM. And I tell you, for a long time, I kept saying the one thing that bothers me about the mid caps and the small caps is what? AD lines, secondary indicator, but they were not pushing higher. So even with that huge move back in late October through much of December, I mean, you can see very little movement to the upside. We were breaking out the new highs at that point, or at least 4-month highs in terms of price action, but the AD line was still dragging way behind those prior highs. Same goes with the IWM. I mean, at the very high, you can see as soon as we started to pull back, we had these AD lines going right back near the lows. None of that looked good to me on the mid caps and small caps. And I said that on the show, on previous shows. The others you can see, I mean, the Dow, S&P, NASDAQ, I mean, I don't know that the AD lines could be much stronger. And this is telling you that the market's finishing pretty strong at the end of the days. That's how these AD lines move up. Well, look at mid caps and small caps now. We haven't even broken out on the small caps, and yet we're way ahead of where we were at the end of December. So there's definitely a little change in the air, at least as to how the small and mid cap stocks have been trading. Mid caps already broke out. They've broken out the new price highs, and also you can see the AD line really strong. IWM, not exactly to a new high yet on the AD line, but it has really strengthened this month. And I've been pointing that out when we look at the IWM in a couple minutes on its own chart. I'll remind you about all those hollow candles that we've seen closing yesterday, almost right on the high again. That's what drives that AD line, afternoon buying. Anyway, transports going sideways, but its AD line also has been rising, even though we've been going sideways for a couple months. Still, we got a couple key levels above about 16.2 that we need to clear to the upside. And of course, downside, I've been talking 15.2 support. That continues. But yesterday we did finish down just slightly on the transports, about close to 1/3 of 1%. All right, what led yesterday? Utilities. And you might think, well, that's kind of weird. Well, it's really not weird if you know the history of utilities during the month of March and even April. This is a group that tends to perform pretty well the next 2 months, especially March relative to the S&P 500. So if you're nervous about the market and you want to kind of seek out shelter, I think a lot of folks like to go head for gold. My gold would be utilities from a defensive standpoint. I don't have it set up, but I'll try to remember to show you in this show the seasonality of utilities. It's pretty amazing for the month of March. Anyway, communication services up about 0.8%. Materials jumping a little more than 1/3 of 1%. Those were your three leaders yesterday. There's recreational services jumping more than 5% yesterday. It hasn't been a great group, but with that news coming out with Norwegian Cruise Lines, we did move up. We're still in a downtrend, still fighting now to get back through that 50-day moving average. So the battle is not over for this group, but yesterday was a really nice day. And we did see a lot of those cruise lines moving significantly higher. Specialty retail also had a good day. And this one, when you compare it to recreational services, you can see a pretty big difference. This one just keeps breaking out to new highs. Recreational services, like I said, still we could draw trend lines, and we're still in a downtrend short term. Now you might look at this and say, well, it's kind of like a little bit of a bullish wedge, which I'm not going to disagree. But we'd have to break out of it. You have to confirm that to the upside. Specialty retail just continues to move higher. Love this group. And then here's conventional electricity. And so this was the group that was leading the utilities higher yesterday, gaining 2.2%. And it too has been in a downtrend. But this group also big fan of March, the month of March. So I'm, knowing that March is always, or not always, nothing's always, but is generally a strong month. I think you're seeing some rotation here. February 27th yesterday, I think you got money rotating in, just maybe a little rotation to safety for the month of March. I don't think that's horrible for the long term. Short term, it could be. I've been throwing that out there for a while. I don't like to bet against the secular bull market, but there are a few signals that are telling us short term beware. And moving into utilities yesterday was another one of those, especially if it continues. But we'll keep an eye on that for sure. But anyway, just wanted to point out conventional electricity needing to get through that 50-day moving average, but very interesting that it is starting to make that move, or started to make that move yesterday. 10-year Treasury yield, as I mentioned, the GDP came out 3.2% versus the expected 3.3%. And the personal consumption expenditures, PCE annual rate, expected to come in 2.8%, came in at 3%, so a little higher. So we had growth a little lower and an inflation number a little higher. That just maybe, I don't know, stirs the pot here a little bit in terms of the bears trying to regain control, maybe. Don't know if that's going to happen, but this particular report certainly won't help. And then I think there was, we've got retail inventories, wholesale inventories that came out. I can pull those up for you. Let me see. Retail, the actual came out rising 0.5%. Prior revised was gaining 0.6%. So retail inventory is building a little bit. And then we'll look at inventories at the wholesale level. And those dropped. So for the month of January, wholesale inventories fell 0.1%. And that was a little below consensus estimate, which was looking for a rise of 0.1%. And that is it. Nothing really else out today of significance, unless you like to follow the fuel and the petroleum status report. I don't usually follow that, mostly because I don't trade energy. But if you trade energy, it's something definitely that will move that area of the market. Anyhow, jobless claims tomorrow, personal income and outlays tomorrow, Chicago PMI tomorrow, pending home sales tomorrow. So we got some economic news that we'll need to check out in the morning. And then on Friday, we've got a couple manufacturing reports, the PMI and the ISM, along with construction spending and consumer sentiment. So look for that tomorrow morning. And then, of course, next week, we'll be getting the jobs report. So going to have to buckle up for that again because that can create an extremely volatile market, both stock and bond. So you want to be certainly watching that, but that won't be out until the end of next week. Okay, so looking at the 10-year Treasury yield with all that as a background, bottom line is we just keep, moving to the upside, or at least staying above key yield support. That would be at 4.20%. Continue to point that out. You now got the rising 20-day EMA, which is up to 4.23%. So you got two key levels to watch to the downside. And if both give way, at that point, in my mind, that the short-term uptrend has ended, and we'd be more in sideways consolidation until the yield gives us the next clue. S&P 500. So continuing to move up. Yesterday was up 8 points. We made the gap up several days ago. This would have been last Thursday on the gap higher. We still are holding that gap support. The top of that gap is at 5,038. And right now we're at 5,078, or at least that's where we finished yesterday. So we've got almost a full percentage point down to the top of gap support. The prior highs that certainly now you would think would provide some support before that gap up and breakout. 5,029 back on February 15th, 5,027 on February 9th. A couple of intraday highs. There was one intraday high up around 5,048. So I would just say right around 5,025 to 5,000 and what was it, 38 gap? Yeah, 5,038. Right in that area, that would be the zone that I would watch in the very near term. If that gives way, then you've got the rising 20-day moving average coming up from underneath. 49.91 would be that level. So over the course of the next 1.5, maybe 1.6% to the downside. The S&P will encounter 3 different key support levels. And if you want to throw the bottom of gap support in, that would be 49.81. So literally from 49.81 to 5,038, I count 4 pretty key support levels on the S&P 500. Now, these are short term. They could be broken, especially we've talked about this negative divergence up here. So we got the lower PPO, we've got higher prices. So it's possible we go down and maybe even get to that 50-day moving average, possibly even a little lower. But longer we stay up in this area, or if we break out again, honestly, I think that's lifting the floor for the first quarter. When I first started beginning of the year, I thought the first quarter we might see as low potentially. I think I'd said 45.55 or maybe 4,600. If you recall, that was the breakout above that July high. 4,800 or thereabouts would be that breakout that we have. That was the high back at the beginning of January 2022, right before the cyclical bear market. So 4,800 would be offering up some pretty good price support as well. That to me is worst case scenario, 4,600 to 4,800. I still believe that probably that rising 20-day moving average continues to hold here. But we'll see. March is not typically a great month for growth stocks. We tend to see a lot more rotation into defensive areas. And that's true not only of March, but also of other quarters, the third month of other quarters. So we're talking about June, September, and December. And the thing they all have in common is earnings slowdown. And if you know one thing about the stock market, it's that it's driven by earnings and interest rates. I mean, those are the 2 things that drive the stock market over time. And so one of those elements is missing the third calendar month of every quarter. We stop getting earnings reports. We get some, but most of them are smaller. Very few market moving type earnings reports come out in those months. And so as a result, I think other factors tend to drive the market. And I think that's when some of those secondary indicators creep up and, play a role in perhaps limiting the upside in the market. That's the way I view it going into these third months of calendar quarters. I always say just lower your bar, lower the bar of expectation. Don't expect what we've been seeing from October through January and even into the early part of February, first half of February. Don't expect that in the second half of the first quarter. We could still continue to go higher, but that is not the norm. It's the norm during this October to January period. It's not the norm once you get past about mid-February. So keep all that in mind and just keep your emotions in check. If you're worried about the second half of the second or the first quarter, move to cash. It's not honestly what I would do, but I can't take on everyone's risk. Everybody's different in terms of their risk tolerance. If you're somebody who has, if you're worried about the market going down a little bit here, this is the time of the quarter when it happens more often. Doesn't mean it's going to happen this year, but in evaluating risk, you do take probabilities into account. I do take history into account to some degree. And again, I just lower my expectations. I know that the market has a propensity to drop a little bit between now and middle or end of March. And so if it pulls back a little bit, it's like, okay, that's what it normally does. No big deal. But some of you, like I said, may not have the risk tolerance and you're happy with the gains you've gotten so far and you just want to sit it out. That may be perfectly fine for many. IWM, here was the cup. I'm not going to annotate it, just in saving some time here. There was your uptrend. So if you're going to have a continuation pattern, you have to have a prior trend. You can't continue a trend that's not there. So sometimes I'll have folks, talk to me like right here and say, is this a cup? And I'm like, well, it looks like a cup. It's rounded. Got a left edge here, right edge over here. It looks pretty rounded. But what is it following? Is it following an uptrend? Because usually these cups are trend followers, at least the ones that are meaningful to me. I mean, still you've got overhead resistance, so it's still key to get through. It's just not a cup with handle. So I wouldn't be using measurements. That's what I use patterns for. If they execute, I use the measurement. In this case, uptrend, cup, handle back to the 20-day, which is almost, that's like the poster child as far as I'm concerned. You get a cup. I like to see a handle that goes back to the 20-day. This went right down, put a hammer right on the 20-day, and back up we come. But here is all of those hollow candles I was talking about, where you see these kind of black outlined rectangles, but they're not filled with anything. They're just hollow. And then you see these other rectangles that are filled in red. Well, the ones that are filled in red are the ones that are closing below the open. If you have one that's hollow, you're closing above the open. And if you look, there's a lot of days when we're closing at or near the highs of the day. And that is what's driving this AD line up. We're seeing a lot of afternoon buying. Normally, you don't see that right before a big decline. Usually, you see that before a big move to the upside. So watch this breakout, watch this 205 level. I've been sticking to my theme. I believe small caps are going to have a good year. This breakout would possibly be the first step in seeing that fulfilled. I mean, we went into the year looking pretty good, but we pulled back in January. Now we're coming back up, big level. I think this would be a big breakout on small caps, so keep an eye on that. Transports just sideways consolidating. I know it looks bad when we're going down. It feels good when we're going up, but basically when you look at the chart, it doesn't lie. We're struggling to get through 16.2 and we're holding at 15.2. Tell me which way we break and I'll tell you which way I think the market's going to go. I believe off of an uptrend that this breaks to the upside. That is the more likely scenario with these patterns. We'll see though. Look at the PPO sitting right on the zero line. Zero momentum. I mean, and that's what the chart tells you as well. You don't really need the PPO. Just look at the chart. There's no momentum. Sideways, up, down, up, down, up, down. We're going nowhere. All right, moving on. Let's take a look at the chart of the day. I do want to mention a couple things though first. If you want to try us out, first of all, we've got a live trading room coming up at 10 a.m. this morning. So if you want to be a part of that, 30-day free trial gets you in for the next 5 live trading rooms. We have them every Wednesday. So 30 days would cover 5 live trading rooms. Going to be looking at a lot of companies that have reported. A lot of companies reported last night and this morning. So we're going to be going through that list. I know I have probably about 5 of them that I have written down that I'm going to start off with in the trading room today and dissect them for possible trades during the trading day. Yesterday, I pointed out during the show HIMX. And the thing I said is that when you get a gap up that clears overhead resistance, and this candle body high right here was $12.30 back on May the 8th. HIMX yesterday had earnings. They beat slightly on revenues. Earnings per share, I think they were expecting a small loss. Instead, they had a small profit. So they beat top line, they beat bottom line, and better yet, the opening price was $12.33. Now, we had closed at $10.25. That key level to watch was $12.30 at the opening bell. And we opened at $12.33, beating it by 3 cents. And I've said before, for me, it's just a clue. And again, this comes from years and years and years of research. I don't have a formal study done. But when I see a stock gap up and open, even if it's just a penny, open above key resistance, the odds are better that the stock's going higher after that. And look at yesterday, HIMX, after opening at $12.30, closed at $13.43, which was another $1.23. That's 10% above the opening price. 10% in a day, even after missing the opening gap up. And that's, a lot of folks say, well, I'm going to wait until it gets back down to 10. Yeah, it had good numbers, but I'm still going to wait. Well, 10 and a quarter was before the numbers came out. There's a really good chance with this kind of buying. Look at the volume yesterday. Almost 35 million. Let me go back the last 5 years on a weekly chart. Well, let's go on a daily chart so you can see the daily volume. Actually, I think we only need 4 to go all the way back to when it went public. Well, maybe 5. There we go. Look at the volume coming across here. Here's maybe 16, 17 million. Same there. Maybe 15, 16 there. Here's 20. Here's 14 million. But it doesn't happen very often. Yesterday, 35 million. More than double any other day in its history. That's kind of a big deal. Price volume, that combination, I'm telling you, that's your number one indicator. Turn off CNBC and the, what is it, the Poseidon Adventure or the Hindenburg Omen or whatever the heck they call all these different things. I love it because it's clickbait. I mean, I just turn it off. What they don't tell you, they say, well, the Hindenburg Omen, it's predicted like 25% of big declines. Okay, one of them that it predicted was the March pandemic of 2020. How do you predict that? I mean, who predicts pandemics, 100-year pandemics? We knew something was going on over in China. We had no, I mean, we've had the bird flu, we've had all these other things. We had no idea how bad it was going to be. Are we going to give credit to the Hindenburg Omen for a 100-year pandemic? But anyway, the Hindenburg Omen, or articles that I've read, and again, I haven't done the research on this, so I'm accepting others, which that might be a problem in itself. But I'm just off of other stories, and I've seen it corroborated by multiple stories, which still doesn't make it right. But again, I'm just letting you know I haven't done my research. But what I've heard about the Hindenburg Omen is that it's accurate 25% of the time. I mean, 25% of the time. What's the flip side of that? It's wrong 75% of the time. What kind of signal is that? And yet people throw it out there like, oh my gosh, the market's going to crash. The Hindenburg Omen. And I'm just joking, but there's probably a Poseidon Adventure out there too. I think that was that was a movie probably back in the 70s with Ernest Borgnine. That's that. Now I'm showing my age. McHale's Navy. I just remember him from McHale's Navy. It was one of the first shows that I watched as a kid. Anyway, they'll come up with all kinds of names. Anything for clickbait. And by the way, we got 2 months before it go away in May, so get ready for that one. We're going to hear that one again, probably right before we see a huge rally again into the summer, late spring and into summer, just like we see most years. But hey, if you want to say go away in May, and it's clickbait. And the thing is, the whole going away, and I get off on all these tangents, I'm sorry, but the whole go away in May thing is really based on the market not being as strong from May 1st to October 31st as it is from November 1st to April 30th. And to which I say, you're right. I don't argue with that. The November 1st to April 30th period is much stronger. I got the numbers to back it up. But that doesn't mean you just go away, just blindly go away. So, I mean, May is not a bad month. May is not a bad month at all. In fact, it's the second month of the calendar quarter. And typically, many of the growth stocks fly during the second month. I mean, fly. So, second month of each quarter. So, anyway, just get ready. There's always something flying at us. Just be prepared. I mean, it's hard to be bullish because everybody's always telling you why the market can't go up. And it's no wonder that everybody's brainwashed and never wants to invest in the stock market because they listen to all the crap that is spewed on CNBC and all the media outlets because everybody's competing for clicks. You don't get clicks by saying it's going to be sunny out. You get clicks by saying there's possible tornado. That's how you get clicks. Nobody wants to see the rosy sunshine forecast. They want to see how much damage is going to be created. Is my house going to get turned upside down by the tornado? That's just the way media works. So if you're basing your investing life, if your strategy is to follow CNBC and you're wondering why maybe you don't perform as well as you'd like, well, there's your answer. Follow the trend, follow the bull market. Anyway, ignore all the noise. Let's see. What else do we have today? We got 1 minute to the market opening. Well, one thing I was going to do, I'll give you one thing that we do at EarningsBeats. First of all, we do a lot of research and we put together chart lists. And I get the question a lot, do I need to be a StockCharts member in order to be an EarningsBeats member? And the answer is no. You don't need to be. But if you want to follow how I follow what I do in the market, I follow a StockCharts platform. That's what I use. So for me not to have the StockCharts platform in our service at EarningsBeats would really be weird. I don't know what I would talk about because everything I use is on StockCharts. So that's the reason that I'm always, showing stock charts or chart lists, scanning. This is what I use to trade. So what I tell members is that if you also are an stock charts member, extra or above, you can take all of our work literally and just download it into your account. I'm going to show you what I'm talking about. So first, let's go over here. And I want to get to my chart list and see when I updated this last. Okay, so these were all updated probably a week or 2 weeks ago. So I'm going to show you with the latest because I updated last week on the 23rd. I've been trying to update all the key chart lists once a week. And I actually did a pretty good job of it this particular quarter. But let's go in and get an update on the strong earnings. You'll see right here, strong earnings that I have on this chart list right now. It's showing February 16th. And here are all the stocks that were on here as of February 16th. Well, this has been updated. So let's just assume that I am an EarningsBeats member, but I also have the extra or pro membership at StockCharts. So when Tom comes out, usually in a daily market report, and says, I've updated these chart lists, this is what you would do as a member of EarningsBeats that's also a member of StockCharts. You would come in here and you would say, okay, I need to update the strong earnings chart list. Let me go over to EarningsBeats. This is our member portal. When you sign in, this is what comes up. And right here under stocks, you'll see chart lists. Click on chart lists. We're actually working on this page. We're going to try and make it much more user-friendly. But this gives us a lot of background, the way we have it set up right now. So it explains what these chart lists are. I think it would be easier maybe if we just had links and then you could pull up the definition, or, if you want. That's kind of what we're heading towards, so be patient with that. But here's a strong earnings chart list. Here was the latest list, and it was updated 2/23. So mine's 2/16, so I can get the new list by following these very simple rules. First, password. When you try to download one of our chart lists, it's going to require a password. It's not your EarningsBeats password. It's not your StockCharts password. It is the specific password that we give you on each one of our chart lists. We will have a password that'll be showing. So what you do is you copy this password, not with the parenthesis, just the number. So SECL, strong earnings chart list, followed by 4 numbers. Just hit that and copy. Hit the link for StockCharts. And when they say enter password, paste. Unlock list. All right, so now here is the strong earnings chart list. Now, if you are not a member of EarningsBeats, this is where it will stop, because you can't save it to a chart list in your own account because you're not a member at StockCharts. So what you would do with this is you could go through and look at all my annotations on all these charts. The problem is there's 400 of them, and you're going to be looking at every one. And unless you take notes, like really detailed notes, you're going to probably be looking later and you're going to say, I don't remember. And there you have to go back through 400 charts again. The beauty of the StockCharts membership with the EarningsBeats membership is that I can click on the Save Chart List, Save to Chart List, and I can either save this as a new list and put whatever number I want on it. You have your own numbering system. I can merge this with another chart list. I don't want to do that. I want to replace that February 16th chart list. I need to replace it with this February 23rd chart list. So all I do is I hit the replace button. Then I come down and I find that strong earnings chart list right there, February 16th. I click it. And now if I save the results, I'm going to save the February 23rd list into my February 16th list. So let's do that. And this one, because there are a lot of charts, there's a lot of annotations. This is probably the longest download that you'll experience, which will probably be 15 seconds instead of 5 seconds, or instead of 2 seconds. So it's got to take some time to go through all of these results and post them into your account. But rather than do all that scrolling, and how about the work that it takes to actually get these stocks into this chart list? All right, so there it is. So it's now been saved. I now have all the new information in this chart list. And so I can view chart list. And then what I like to do is edit my chart list. Once we get there we go. And you can see, by the way, here are the top performers this morning right now. CLSK, Coin, Helen of Troy, got Ferrari, There's booking, waste management. Anyway, these are the leaders so far this morning in this chart list. But now what I want to do is I want to put it into edit form, because here I can just go in here now, and instead of February 16th, it's February 23rd. I save, boom. Now I was kind of walking you through that, and it probably took me a minute maybe from start to finish to start downloading to actually make that change. But now, if I'm going down my chart list, now I have the strong earnings saved February 23rd. And all I do is I just go in when these other chart lists are updated and do the exact same thing. And literally within maybe 10 or 15 minutes tops, I have all new chart lists that I can run. Then what I can do is I can go in. I haven't updated the raised guidance, but sometimes what I like to do is just say, I'll just run a scan and say, give me, all my chart lists are already filtered for volume, so I don't worry about volume filters. But looking at my chart list, I'm going to run a scan of my new strong earnings chart list. And let's say I updated raised guidance. I haven't, but let's say I did. There's the February 16th. So let's just assume I've already updated it for February 23rd. And I put that in there. And I didn't hit the add on the other one, strong earnings. Add. And now what I can do is I can run a scan that tells me which stocks are on both of these chart lists. So whatever list of stocks that are returned from this scan, it tells me they beat revenue estimates, they beat earnings estimates, and they raised guidance in their most recent quarter. That's what this would tell me by running this scan. So I run this scan. Now I'm down to 117 stocks. So I could then sort this by scooter, get the best scooter scores, super micro. No shock there, right? I mean, this stock's been absolutely unbelievable. Finally slowing down a little bit. CrowdStrike, you can see ESTC, NVIDIA, AppLovin, Meta. I mean, if you follow the market and you trade a lot, you're going to find a lot of really good stocks on this list that have great scooter. The scooter is the StockCharts technical rank, by the way. That's just telling us relative strength. So there's so many things you can do with the information on the StockCharts platform that I can't do without it. I've been a StockCharts member. We get nothing from you subscribing to StockCharts, nothing, zero. Other than maybe just build our relationship because we're helping StockCharts. They're helping us. I do articles over there. I've done many shows over there. So I've done a lot of stuff for StockCharts that helps EarningsBeats. So we've got that kind of relationship, but there's no monetary relationship between StockCharts and EarningsBeats. So if I say go, I recommend you go over and subscribe, I get nothing for that. But if you're an EarningsBeats member, I get a lot for that, because now I know you can utilize our research so much faster and so much easier. And so that's what I always tell members is it's worth it. It's worth it to have both. Now, some are like, well, yeah, but I don't use that platform. I have a different platform, and that's fine. And if you go into our website, by the way, right below the StockCharts link is a Microsoft Excel link. So you can take this chart list and download the symbols into Excel and load it into another platform. So we try to appease those who don't use the StockCharts platform. Anyhow, let's take a look, see what's going on in the market, and then we'll wrap this thing up. So we got the Dow down 200 points, of 0.5%. S&P, NASDAQ still in that 0.2 to 0.4 range. Small caps down a little bit more today, down 0.82. Looking at the S&P 500, eBay, First Solar, Agilent, all three of these reported earnings. So did Republic Service. And these four, having reported earnings, are at the top of the S&P 500 list. Let's see what's at the bottom of the list. Seeing if there's any, Applied Materials, that's a semiconductor, down a little bit today. Not really anything else. Just kind of, there's the Norwegian Cruise Lines, by the way, up another 2.5%. So that's had a pretty decent run here over the last couple of days since reporting earnings. Axon, this was a defense or aerospace stock. We had this in our portfolios last quarter, one of our portfolios. I think it might have been in the aggressive. I don't remember which one. But anyway, it reported earnings a couple of days ago and had a pretty nice day. and also jumping again today, breaking to another new high. But anyway, that's it. We have a live trading room coming up in 21 minutes. So go over to earningsbeats.com. Make sure you sign up for a 30-day trial and come in and join us. Going to take a look at a lot of these earnings reports and see where we might find some key levels of support or resistance for those who maybe want to short. I'm not going to do that, but I may take a look at some long positions here. Anyway, hopefully I'll see you in about 20 minutes in that live trading room. Otherwise, I will see you tomorrow morning for your next Trading Places Live. Again, hit that like button, click the subscribe. That helps us with the YouTube algorithm. So even if you're not helping us financially, you can still help us through those two avenues in building our community here on YouTube. Have a great day, everybody. Happy trading.